I am a pretty analytical person. I do talk a lot of detail and a lot of sort of refined logic, I guess, for the model that we're actually investing in. I'm going to try and keep it pretty high level. After studying macroeconomics from a guy that wrote a thesis on money laundering, there's a lot more that I can obviously teach you legally, but at the same time, it's important that I just keep this fresh for everybody, because some of you that I have spoken to, I have bored you to death, obviously, with information regarding the economy and regarding the market, but I'm going to touch on it again, because everybody needs to be at the same sort of level, okay? At the same time, I encourage questions, okay? So please just stop me if you've got any questions. Yes, Penny. I'm kidding. And yes, for those who haven't met me yet, I've got a weird sense of humour, so don't be surprised if I come and sit on your lap halfway through this, because I've not slept yet. We're in the US, in case you didn't know. US of A, lower 48, for anybody else that didn't know. 311 million people. I will walk around too, because it's just something I do, which really aggravates my man on the camera here, you poor bugger. 311 million people, 125 million households. These figures will make sense in a second. 75 million by owners. Okay, so you're already starting to do the math and obviously figure out who owns what right now. This is obviously post-apocalypse. This is obviously after the banks are holding a considerable amount of real estate, which we'll also get into in just a minute here. 34 million by renters, that's your market. Those are your tenants. Realistically, maybe 5 million of them are. Because obviously there's a certain band of properties that you're going to be in there with. Some you really don't want as tenants. Others you just, if you've got $5 million to spend on their penthouse in Manhattan, go for it. But that's a lot more property in other parts of the world you can make a lot more money with. The properties that were actually built, obviously before 1973, because there were spurts of growth. There are different periods where the economy was flourishing, where the actual birth rates were just skyrocketing at the same time due to different levels of contraception that were available at the time. And of course, what we're actually looking to do there is track the condition of the properties that we're getting into. There were obviously a lot of construction right after the Second World War. A certain type of construction as well that was specifically built just for the returning soldiers and obviously their new families that were coming out. You'll actually find that those are a lot of the properties that we buy. Okay, and we'll touch on that obviously throughout the week as well. 32 million are in central cities, 52 million are in suburbs. Now this is once again, it points to a certain criteria. We'll go to the other one. Did you know these are scented? These actually smell pretty. I don't know if that matters to anybody else. Just quickly, this is the city that we're getting into, for example. Let's say it was founded in 1800s. Don't be surprised, but some of these cities were. This growth ring, and obviously every year that they are expanding, let's put that at about 1900, 1920, 1940, and we'll go 2000 just to be naughty. Okay, so what we're generally looking for, because obviously this is where you've got the oldest parts of the city, it's where the commercial areas are, obviously for the high-rise towers with everybody living and working in them. You've got other growth rings that obviously have different types of construction. Californian bungalow is something that we get a lot of in Australia, that you'll see a lot of in the US, because obviously it's a derivative that comes actually from the US economy, from the US architecture styles. Excuse me. Now, one of the other points that we actually get to, the further you go out, the less infrastructure there is. I'm not too sure if you guys can see that up the back, but my main man on the camera obviously can't reach his little dial at the moment, so please just bear with us. But obviously what it really is trying to point out here is the fact that what we're trying to look for is a certain growth ring of the city. Nothing too close in where it's too congested, crime rates are a little bit too high, a lot of other variables we just don't want to contend with. Nothing too far out, because obviously these are going to be a different type of property that we may not want to get into just right now, because it's obviously going to be a lot more expensive, because there's going to be a lot more crime issues that we find out in those sort of outer rings of the city that we're actually getting into, and a bunch of other reasons which we're going to be touching on in greater detail throughout our 3-city tour, as well as obviously a lot more tomorrow when I've got the Americans actually on stage. Excuse me, but it becomes very clear after you start going through a couple of these cities with us and you identify, okay, well let's say I'm picking up a property, and don't laugh, but the oldest property we've ever sold is 1890, okay, and it was built in a period that didn't use power tools. It's all hand constructed. It was during a period where they didn't even know what the term plan redundancy means, obviously, so they didn't build it just overnight and throw somebody in there really quickly. Excuse me. The other point being, obviously, that when we're getting into these areas of infrastructure, we're getting into them obviously because it's got everything we need, but it's obviously where the target demographic of those renters that we're looking for are actually located or wanting to move to. Because it basically is just an overlapping mesh of economics. That's literally what we're getting into. It's a lot easier than I basically can make it sound at sometimes, so like I said, I apologize for people on the phone when I've been talking to them without a diagram. There's one right now. Okay, so 52 million in suburbs, 76 million are single-family homes. Okay, so that's basically a young couple. That's one of your key demographics. Bell curve will come to in a minute. because you're actually looking at a property style that's going to have a certain type of longevity to it. You can get a single person that's going to move in. They're typically going to move out within a 24-month period. Okay? You don't really want them. They're fine, but you want someone who's going to be there for 3 to 5, possibly longer. So you're going to be looking for a family that wants the sort of stability. Okay? So a young couple. Perfect. There's some of your demographic right there. 6 million of these properties, by the way, are actually condominiums. Excuse me. That's your single population. That's what they're moving into. That's the young couples that fight, break up, fight over the lease, go their separate ways. Another demographic you don't want to get into, okay? He knows what I'm talking about. Okay, so 85% of US homes have air conditioning. Why have I brought that up? Simply because you want a property that has an air conditioner in it. Every single property we have has an air conditioner in it, has central heating in it, has certain elements that your demographics are looking for, okay? Even if they're in a let's say, Kansas City, it gets to minus 30 degrees, even a little bit colder than that in some parts of the year. It gets up to 40, 45. They've had a blistering summer. Air conditioners were humping through the roof at this point. That's why it's obviously very important for these people to actually have air conditioning. Okay? Seems simple, but it actually does bring back logic. And of course, 85% of all US homes, that's 15% of people who don't live with it. Okay? Which actually is not that much. 48% have a separate dining room. Once again, why would I bring that in? Simply because when you're looking at the overlay of your floor plan, that's actually what they're looking for as part of their family environment. They want somewhere they can sit and have meals, and obviously their Thanksgiving dinners, which is coming up next month. Anybody still here in November, stick around, it's an amazing show. And obviously 34% have a working fireplace. Now, once again, there are so many other variables you can contend with, so many other things that a tenant is actually looking for. But of course, being conditioned from Australia, you're perhaps thinking of it from a world whereby they're looking for a large yard. They're looking for whatever you're conditioned to think. I'm not going to give you a toxic perspective just now because there are so many other areas that we actually invest in that have different requirements. When we're in Phoenix, for example, air conditioning is a must, not necessarily have a heater. Some of the properties we sold in Phoenix had no heater, okay? At the same time, when you're trying to rationale that on your break-even averages, when you're actually figuring out how much money you're getting back, that's one maintenance cost you're not having to pay for, which doesn't sound like much to you, but it's something that we've already thought of. Okay, it's another element you're not going to have to come back and fix in 3, 5, 10 years' time. Why buy a property that has a heater when you can get a property that has a fireplace? They're going to use it once every 2 years. It costs them nothing to have it sitting there. You've got to think, obviously, from a longer-term perspective against what you actually need in a property for it to be functional yet attractive to the tenant. This is obviously what we all do for you. For the people that I haven't spoken to before, by the way, I've lived in the US for 4 years. I've lived in Canada for 2 years. I've traveled to every single state in the US apart from Alaska, Ben Wall's home state. I have a Texan fiance, whether she likes it or not. She actually prefers to be known as a Canadian, but she is a Texan, so you can feel sorry for me later. But it's important to me to obviously reiterate the fact that you need to be speaking with people who understand the environment, understand the economy, occasionally use the letter R, because it does actually make a difference. That's another reason why we've got all the contacts in place, so you don't obviously have to get burdened by certain other elements that you may not want to bother researching. Excuse me, you may not want to have a service technician email you and say, well, you know, because you're an Australian, they won't say this, but the price will go up 300, 400, 800%. The first property I ever bought in Seattle, we actually spent about 14 grand more than we needed to, just because we'd never done it before. There wasn't something like this to be able to assist us. Other parts of my background, which I can bore you individually with later, is sort of irrelevant at this point, is basically to make sure that you people are looked after, okay, and that obviously we walk you through a whole world of different, understandings. No two people in this room are going to have the same requirement, and they're going to have the same questions or the same perspective. That's why we like to spend as much time one-on-one with you as possible to make sure you're getting the information that's relative to you, okay? Now we're going to go through some very, very boring analytics, as I'm also pretty well known for. Before we tickle over to that, and this is why I encourage you just to keep asking questions, we're going to be talking a lot, and I'm about to lose my voice, as we usually find out when Joel starts talking anyway. But does anybody have any questions at this stage before I roll on through? No? Outstanding. Okay. Everybody knows what this is. This is a bell curve. This is a basic element of how most people will analyze large amounts of data. A good friend of mine actually analyzes data for the CSIRO. He's probably the second most boring person I know in the world, but he's one of the smartest. And he actually broke apart most of these models just so we could obviously basically make it understandable for other people in the greater economy. Now, these are typically basically an illustration of different time periods as well as obviously different condensing of figures. This is basically just an overview of what happens. You're looking at some of the earlier investors that get in what they call smart money, okay? They see what's happening before it even takes off. These are the guys who saw Facebook before it was Facebook. These are the guys who saw Google before it was Google. Bear in mind, the internet's only like 4,000 days old, or thereabouts. Like I said, I've got an assistant accountant, so I don't have to count too much. You've got institutional investors. Then, at this stage, you don't basically have the public. Now, this is built in regards to the US property market, as you can tell, because what we actually have here, and then the drop-off, is what's termed in a property circle as a market correction. Okay, so wherever there's basically a spike or a hyperinflated point, there's always a drop-off back to it. Historically speaking, you look at any market, any Western society, historically proven, that actually has a market correction into it. Okay, so typically, obviously, you've got those growth cycles. This can be a part of a number of variables, quite considerable variables. I mean, inflation being one of the easiest ones for us to understand at this point. Bear in mind, you're now dealing with two levels of inflation, Australian and the US, which we'll go through in greater detail probably tomorrow. But obviously what we're really looking for is for those levels of demand. And as you obviously see over here, excuse me, when the greater public and some of the institutional investors actually flow onto this, when they identify this spike, they actually come right up. They realize obviously that it's hit, or it's basically being pushed above its greed value, or its mean average, and that's when basically they panic. They drop back down. That's the simplest way to understand it. That's typically what's actually happened in the discotheque. Okay, so that's Goro, he loves to party. So typically what we're also looking for is when that market corrects, because this is the true value of what we're actually investing in. Okay, this is what we should have hit it. This is when you should have sold it, theoretically. If you're lucky, maybe a little bit of a gamble, which you're in the perfect place for, you'd sell it there. But how would you know that the following weekend it'd tank out and you'd lose all the capital? If you started investing here, for example, you ended up owning something down there, what would you do? You'd hang on to it, because it's not going to go anywhere. It's a physical asset. It's still worth something. If that's a share, the company just went bankrupt, you've just lost your retirement. This is a property. It's a physical asset that's worth a lot more just to build it than you can buy it for. But we touch on that obviously in greater detail as well. So let's get bored. Okay, this is basically some of the property averages that we're looking at before. I have presented this before, so some of you obviously would have had the pleasure of getting through this, but we'll try and go through it as quickly as possible, and we can come back and touch on it individually if you'd like. What we're actually looking here at the actual prices of homes in these select states. We've included California here, basically because you can actually find most of the properties in California, New York, the populous states, for example, suffered. They suffered greatly. But your per capita average, you've got a lot more people there. Okay, so you actually have to factor that in again. This is broken against a per capita average of 1 in 100 ratio, which basically means that instead of saying you've got 35 million people in California, and let's say 2 million in Oregon, they've actually given it a ratio so it's more accurate against one another. Instead of saying that one is basically identical, they're not. What we're really looking at here is basically just that market correction again. You're looking at obviously some declines in some areas. We're picking out California right here. People are leaving California at this point. If you look at the years down the bottom at here, late 90s coming into the early noughties, they were in decline. There's a lot of unemployment issues there, a lot of other health issues, safety issues, which I'm sure everyone's seen Cops. I call it the Cops mentality. It was a dangerous place to live and walk. Even around Disneyland, which is a story I can tell people one-on-one at another point. Excuse me. We're also looking at obviously other states which came up a little bit higher. Now, typically what was happening in Oregon at this stage is actually a lot of natural resource investment at that stage. There was a couple of other burgeoning industries that people were very excited to be getting into. But the real reason I like this slide, and the real reason we're about to launch into one of my favorite states, apart from my fiance, which we're obviously going to be very lucky to get back in there. See this black line right through the center? That did not drop off right up to 2010, did not decline, even through a GFC. That's Texas. Now, we've talked about properties we can get for about 30 grand so far. They're probably worth in the market 50, 55. At their peak, maybe 100, 150, depends on the property, depends on the state, depends on the variables. Dallas, and this is where it comes back to the psychology of the buyer, the psychology of the renter. Dallas did not have a lot of incumbent debt. These areas that suffered basically were people that had mortgages. That's why they obviously suffered, okay? These areas obviously that didn't suffer as much, less incumbent debt theoretically, yet the property prices still just declined, okay? You're looking at Dallas and Texas here, and we've got some properties there that previously were selling for $500,000, and we can get them for about 100 grand. Okay, so the capital appreciation or the market correction, when that does actually come back up, because wherever there's a market correction, it will recover to the point it dropped off at and then exceed it by at least 1 basis point, being 1%. So let's say its true mean average was here. We're waiting for that recovery point to come back up and hit it again. You buy it 100K here, it was valued at, let's say, 500K here. You're going to wait for it to get back up there before you consider selling it. Not factoring in inflation, not factoring in exchange rate, not factoring in anything else because it makes it complicated right now. But let it just hit 500 in the greenback. Everything else will take care of itself. This is why that's one of my favorite slides, and it actually goes to explain why we're getting into Dallas. Pretty much if you were looking for, let's say, the Kansas City, Phoenix, Atlanta, Georgia, any of the other markets we've gotten into, you're actually going to be looking closer to that blue line right there, being the California, to its spike point, so basically as high as it got. But you'd also look at it tracking like this, pretty much similar to the red one, being Arizona, obviously right there. Because what you're really focused on at this point is where it got to at its highest peak level, and specifically at the date range that it got there. Because that hyperinflation point I'm telling you about, that's happening about here, okay? Right about the 2000, 2005, okay? Not of other variables. Yeah, we'll flip on to the next one. Okay, so this is basically another point of what I've just already discussed. This is the national average, and once again, excuse me, this is going against the actual nominal house value. You see the mean average, that line right in the basically the bubble there, that's the trend that it should actually be hitting, okay? Now obviously once again we come through for a period where they deregulated the market, and that actually spiked those prices when there's a lot of toxic mortgages going out there. Dead people got mortgages at this point, I kid you not. There's the term in banking, there's a lot of terms in banking that I could go into, some of them quite inappropriate for the kiddies at home, so I won't. But one of them, obviously, they still use today is called robo-banking, where it's all automatic. They were stamping loans they've never even checked the ID on. They wouldn't even check the address. They were giving money out just because of the sake they could make so much more off it in the MBS world, the mortgage-backed securities. The MBS world is something that we're going to go into in detail tomorrow. I thought if anyone who's flown in tonight or today is still jet lagged, they're just not going to hear it. And it's going to be pretty in-depth of knowledge sort of stuff. So we'll touch on that again tomorrow. But what I'm really trying to illustrate, obviously, in this point, are these market corrections. And I'll flip across here at the end. Anybody knows, obviously, what Australia's GDP is right now? Anybody? Nobody? Anybody know what a US's gross domestic product is? No. Okay. We're speaking to the right person. US's gross domestic product is about $15 trillion. Ours is 1. Okay. The US could theoretically pay off its debt in 1 year. Theoretically. It couldn't. It's going to take decades for them to pay that back. But at the same time, what we're looking at here again is an average. It's a percentile they're based against a ratio. You're looking at the USA there, which just spiked in this period here. And obviously when you look at what that was, very volatile time for the US economy. One of the few economies that's ever made it through a Great Depression and succeeded to be a market leader after the fact. Okay, so there's a number of reasons why we're still here. But what we're really looking at again, we suffered. We suffered a little. Everyone's aware of that. Unfortunately, most people's superannuation, it was in a hedge fund, we're obviously very much aware of it. However, the US still suffered. It actually dropped probably about another almost 35 basis points off this average right here. And these pictures are basically telling you that if you invested at certain periods, remember that bell chart that I showed you before, you invested at certain periods, you'd be a very happy person. Now that we're in a period of recovery, obviously, what we're looking for is the upturn in these markets, the market change, obviously. This is basically an averaging, excuse me, you're looking at the actual price of the property and the amount of mortgages going out for those properties, okay? And you can see the correlation here. You can see obviously as the increase in the actual price is changing, the actual increase in the volatility right there of the amount of mortgages out there. Bear in mind, you get to a saturation point where people who don't need a mortgage don't apply for one, but people who have a mortgage refinance one, and they just keep flipping that in and out. And they obviously get to a point where it's just too toxic for them to stay in that market. So what they're obviously looking to do at that point is bail. As Lee said a little bit earlier, jingle mail. It's not their problem. It's what they call non-recourse lending. Anyone here in Australia have an Australian mortgage? Lucky people, okay. What you basically have is a certain ownership of borrowing. If you default on your loan, they'll come looking for you. They'll take the house and they'll come looking for you. You default on your loan here, they'll just take the house. You'll basically take a hit on your credit score, but they'll do nothing more. It's non-recourse lending, what I can get for you in the US, and you don't even have to live here. Okay, it's pretty phenomenal. What you're actually looking for here as well, Goro and the lights, that's awesome. What you're actually looking for as well is see how you've got this fluctuation, this change? This is just uncanny. Seriously, do you know how it's really hard? Oh man, I'll tell you what. I'm gonna go hit somebody up the back here for a second. See the volatility, see the changeover? That's when the MBS, the mortgage-backed securities issues actually started to come to basically our dinner plate. We actually got to a point where unfortunately banks said, no, I can't loan to you. And all of a sudden you see where it starts to spike up again, what they call the mortgage accelerator, okay? That's when the property prices are down. No one can buy a property, no lending's going out, no one's buying, yet the banks are holding property. Very confusing scenario they've never dealt with before. And they're obviously still in a period of trying to mop that up. Banks still hold a majority of the defaulted property. They've done so basically out of goodwill via the government. Excuse me. Because what they're really doing, they're actually suppressing the market from hyperinflation again. They're making sure that if they threw about 3 million homes out there, there's going to be properties selling again on eBay for $1. And you can get them. Go and have a look. Properties on eBay for $1. You won't be able to do anything with it. The copper is probably worth more than your actual computer itself. It's probably the only thing you'd do. But at the same time, there's reasons why the actual cities will take ownership of these properties and make sure they're looked after. Once again, another chart. I'm actually going to cool on these charts in a minute because they're even giving me a headache. But what we're, again, looking at here is the debt ratio, because obviously as the price of these properties goes up, and there is a reasonably good reason this actually starts tracking at the late 1970s, early 1980s. Anybody tell me what that is? Nobody tells me what that is. I haven't spent enough time on the phone with lovely people here yet. This is a period where we basically started trading with US Treasury bonds in a world they call the MBS, mortgage-backed securities. That's where they take A, B, C, D, up to F-class mortgages, and they sell them into the market, and they leverage them as basically a trading option. It's a security, it's an instrument. It's an instrument to trade with. They started bundling them up all together. They started putting them out in the market, and obviously we got into a position where people weren't paying back to the people who were A-class mortgages against the people who weren't, the F-class mortgages. Basically everybody suffered. Long story short, we took hits. That's it in a nutshell. We'll go into a lot more detail further down. I'll actually give you some reference material as well for anybody that likes reading excuse me, legal documents, budget reports, anything like that. It's not many people, but you can't get this one on tape, but I'll give you the URL for it in a minute. We'll chat about that in just a second. But we're just going to touch on, obviously, who owns the national debt. Now, we're going to realize something pretty incredible in a minute here. The US actually owns most of its own debt. They actually hold most of their own problem. But people invest in the amount of money that the government owns. They literally own these as instruments of investment. Because what's basically happening is the US economy is saying, okay, well, I've got this debt that I'll sell to you for 60 cents on the dollar that you can sell back to me for a full dollar in 3, 5, 10, 15 years' time. I've actually held a sheet of paper, which is a certified bond worth $5 billion, just one sheet of paper. And I can take that back to the Reserve Treasury. Not many people in the world are actually licensed to be able to operate with these. But you can take that back to the Treasury. You can't wander into your branch and just go check it in. You take it back to the Treasury, they'll fund it to your Swiss account or to a certain European account, and off you go. It's not my bond otherwise. Otherwise we'd all be buying free property. I can't do that for you yet, but I've got finance options for you. If you're looking at banking centres in the Caribbean, that's obviously your British Virgin Islands, your Cayman, your things like that. I mean, these are all entities that have basically said to, basically the US Treasury, I will hold X amount of stock and I'll buy it 40 cents on the dollar, 30 cents on the dollar, 70 cents on the dollar, and you're going to give me $1 back for it in months, years to come. Okay? You look right down to the point where we actually start getting involved in governments. Oil exporters, by the way, you'll have no idea who that used to be, or that currently is. That's Libya, that's Iraq, that's Kuwait. That's all the countries the US has previously been at war or at war with. They actually hold this debt. Why wouldn't they? You buy something right now, 50 cents on the dollar, you can make double your money back in 3 to 5 years period. Who wouldn't do this? Okay, if you want to do it, talk to me, I can figure something out for you. But the key of it is, these are institutions that do a lot of due diligence. These are institutions that obviously vet these projects very thoroughly. It could take 10 years for them to get their money back, depending on the negotiation of what they've done. But if these people are investing in a debt of such a suffering economy, surely they've got to be onto something. Surely. We're actually looking at mutual funds here, pension funds, Japan, China. China is actually down from $1.3 trillion because the US have been paying them back. Okay? They're actually paying back most of these debts because the government actually found they can obviously take back most of this debt and hold it for themselves. What these debts obviously really are at this stage is people's social security. That's their pension. It's their 401k. This is the money the government's giving out. Now there's all these different other terms like basically quantitative easing, which is when they're just printing money, which they did back in the Depression, basically to nudge around the rates of inflation and obviously make sure that everyone's taken care of. But what they're really doing here is just making sure that they can control their own destiny. Okay? Japan, everyone's saying, what if Japan or China turns around tomorrow and actually says, give me back my money, otherwise, excuse me, I'm cancelling our relationship. They won't do it. China is actually just a little freckle in how much the US imports out of the global economy. It's a tiny little freckle. China they would not jeopardize that relationship. It's just not worth it for them. Okay, similar to Japan. It's another reason why they just don't touch that relationship just yet. In fact, Japan, China, and a couple of other countries are wanting to buy more of this debt because they see the return, the potential that's going to come back off it. US won't let them. Okay, but you can. You can buy it in tiny little amounts. You can benefit from it in a very different way being US property. Now, there was a report that was done that basically illustrated back in 2000 that the US could have actually paid back all of their debts at one time. Everyone got my number? Yep, good. You need a bail bondsman while you're in town, you let me know. I've got a good one. But in 2000, what they could have done is they could have actually paid back their debt. 236 billion was their surplus in 2000. That's how much they made as a profit. It's never good for a government or any entity to be in surplus because it's a waste of money. What are they going to do with it? Put it in a 5% CDC? Put it in ING Direct? Which is actually good, don't get me wrong, but you know what I'm talking about. They should be in a deficit because then they're actually leveraging into the market, they're making more money. This is obviously what they're trying to do now, is pay down this debt so they can control a lot more of these treasury bonds. Instead of selling them at 50 cents, 60 cents, whatever it might be, they can sell them at 85 cents, 89 cents. Be a little bit more aggressive in the market, give out less cash, make more cash. Very important factor for them to have. They're obviously tidying up their spending. Poor Obama is doing a hell of a job. Anyone heard the US presidential election recently? You know they're running for another president this year? Did you know his campaign is in debt by about $7 million? And he's one of the richest candidates ever to run for presidency. What does that tell you? The guy's already in debt and he hasn't even taken over the country yet. It's pretty scary. Even though Obama put them back into $4 trillion of additional debt, bear in mind he's taken this over from a Bush economy, which took over from a Clinton economy, which took over from a Reagan economy. And all these presidents have had different budgets that actually overlap into the other presidencies. Okay, so Obama inherited this debt. He had nothing to do with it, no control over it. But obviously look what he's been able to do so far. He's dropped the unemployment rate pretty significantly, almost 1% in 1 year. Out of an economy of 311 million people, that's impressive. He's making something out of nothing. That's really impressive. I'd love to see Gillard do that. Sorry for any people who follow that. This is the document. Top right-hand corner here, preliminary and close hold official use only. That's basically a polite way, because they knew that through the Freedom of Information Act, this would be released eventually. But this is like saying, don't give this to people, because it'll embarrass us. This document, the URL's on the bottom of it. Okay, I highly encourage you, if you can't sleep, and let's face it, I don't know anyone else who's slept recently, you're in Vegas, have a read of this doc. It's about 60 pages long, it's good material, it's a great perspective in there, and it tells them why they should pay back their debt. But at the same time, if we get into an environment, here's what's basically happening. Those bell charts again, we're about 2000, the noughties here. Current, let's say, just to be rude, 1890, it's not really that late, but what was basically happening is the debt peaked, and they were in a situation where they could have paid it back, and paid it back within 12 years. They'd be debt-free today. They'd have zero owings. You know, they could obviously have a lot more than a quarter of a $1 trillion. What actually happened, a whole bunch of legislation came through. They actually took away a protective shield that deregulated their banks, and a lot of other things that actually impacted basically from the internal investment circle, the global investment circle, the retail investment circle. Okay, so a lot of these environments basically collided, which therefore started doing this. Okay, everyone else is noticing the lights are going up and down. It's not just me from lack of sleep. Yeah, awesome. Okay, thank God for that. Okay, so what we're doing here is basically they were in a period they could have paid down this debt. Now, if they paid down this debt, bear in mind they sell debt in the market as, for this example, mortgage-backed securities. Okay, they sell $1 billion worth of mortgage-backed securities in the market for, let's say, 80 cents in the dollar. Bear in mind, the person who invests in it is going to make 20 cents. They take this 80 cents, put it into market, they invest that again, they can turn that into $1.20, for example. That's a quick way to explain what actually happens. Does that make sense to people? Basically what they're doing here is they're leveraging a debt. It's like you borrowing for the purpose of buying an actual house. That's 10 push-ups for the phone ringing, by the way. Okay, I'll make her do it. She's from the army, she can do it. 20? Yeah. What's basically happening here is they're borrowing. It's like a leverage fund. It's basically like a margin call, margin borrowing. You're basically taking a future debt, getting the cash for it, investing it into another environment, making that money. So even though you're taking a hit here of 20 cents, you've made it back in the profit here, and you've made an additional 20 cents. Multiply that by $1 trillion, and you get a healthy economy. If they paid back all of their debts, they'd have nothing left to be able to put into the market to be able to do this with. They would lose their place as the capitalist giant. They would lose their place to be able to obviously leverage into a greater marketplace and make a fortune. And they were doing this very successfully for a long time. However, people got greedy, as they do. It's human nature, unfortunately. If you can, read through this document. because it basically goes to explain, even though right now they're in a period where they can't afford to pay back these debts, they're in a period very shortly where this will actually start to make sense again. Okay, and there's a lot of good perspectives. Anything that you obviously see here today that I just quickly flick over, for example, just ask me and I'll get it to you. Okay, I don't sleep, so it's just what I'm here for. Any questions on that? Life after debt, good article, no pictures, a couple of graphs, that's about it. Okay, so I'm going to stop boring you with numbers very quickly. We're going to come back and touch on this tomorrow, so if I don't see any of you here specifically tomorrow, I know where you live. I've got it written down somewhere. I'll just come and knock on your door, we'll have a cup of tea, I'll talk you senseless with numbers. The 3-city tour in the US. Who's coming with us around the cities in the US? Fantastic. I'm not letting you come with us. I've heard what you do. You're going to have a lot of fun, but the real purpose of doing this is to saturate you in an environment. Everyone, who's not been to Vegas before, for example? Wow, okay. There's this thing where you actually have to give your host money just for coming to the city. It's actually a pretty common tradition. It's otherwise known as bail. One thing that most people seem to forget, I think, is that it's all well and good to summarize what a city is or how a city will work until you get there. It's completely different. Like the Eiffel Tower out there on the Strip, for example, it's a lot shorter than I thought most people would actually probably imagine it to be. It's not the real Eiffel Tower, for example. We put you in, let's say Kansas City is our first stop, okay? Now Kansas City is an interesting place because it sits right on the border of Kansas and Missouri, but we're going to the Missouri part. Anybody staying at the same hotel that I put in listed? You are? Cool. We're going to be in a place they call KCK, Kansas City, Kansas. It's an area you don't want to be in, but it's a very secure hotel with great police, so we're going to be fine. Okay? The reason is, there's no point in me just taking you to where our properties are and look how great it is. You need to understand why we're not in this section of the city and why we obviously maybe not investing in one other part of the city just yet, and why obviously the Strip with all the security guards out the front of the houses isn't an area we're going to waste money on because we're not going to make the same net returns. Once we're in the environment, it starts to make a lot more sense. And while we're on the ground in these cities, we're going to be going to a lot of due diligence. And this is where it actually starts to make sense. How we pick our properties, how we vet our properties. Because instead of some guy or girl sitting on the other side of the world going, yeah, it's a great property, look at the picket fence, it's lovely. You need someone who's actually there on the ground, looking up and down the street, checking on the actual criminal history of the area, checking on the actual processing of vetting tenants, checking on the actual condition of the roof, checking on the actual foundations. Moreover, checking to see what the actual council or the municipality's guide is going to be for putting in another road in the next 10 years, another highway right next door in the next 5 years, underline PowerPoint or water main, whatever it might be. You need someone who's going to vet all of these different stages for you. Moreover, it's always good to be buying a property today on the fact that it's $50,000 and giving you 15% net return, but where is it going to be in 3 years, 5 years, 10 years, 20 years? Because if none of you buy it, I'll buy it. If I don't buy it, we're holding it for 2 decades, minimum. That's how we buy and that's how we vet our properties, okay? We're going in a small group tour. So this is the other reason. We actually, unfortunately, we had turned some people away because they're not really in a position where this would be of any benefit to them, okay? Sometimes it's not the easiest thing for me to tell somebody that they shouldn't be investing in the US. It's not my decision, but for some people, it's just not right for them yet, okay? The last thing they should be doing is wasting their time, wasting their money, okay? Sometimes it's always just better for me to tell them up front. And it can get quite upsetting at stages, and I have been bribed with penfolds, which sometimes does not work. But what we're really going to be looking to do on these tours is just to make sure that you guys have full exposure, full clarity, get all your questions answered, meet some of your key people, meet your property managers. We've got Peter G. Anyone investing in Kansas City? Yep, you're going to meet Peter G., lovely Australian guy. I ate all of his caramel koalas on the flight over, so he's not going to be too happy with me. But you're going to meet, you put faces to names, and it'll make you a little bit more at ease. These are people you can call up in the middle of the night, literally try it, it's quite funny, or Skype them, just email them, they'll respond, that's what they're there for. They're very encouraging, they're great people to be around.
What are the circumstances where you have to turn them away? Why do you think they're not ready?
Their perspective in the market is completely different. Either they don't have enough funds, like because once they pay for a membership, which pays for ridiculous people like myself and the rest of the amazing team, they won't have enough money to start with. The funds they've got is what they've saved for 10 years, and it's detrimental for them to buy a membership if they can't get into property. They may as well be looking at another strategy like foreign exchange trading, which you're all doing if you're buying US property, or Sharelord, or John Thompson even, something a little bit more close to home that they don't have to basically fly to the other side of the world and come on a trip like this for. Or that they basically might be a little bit more adept at their current level of understanding and mindset. I don't trade. I think everyone knows that I don't trade. I've blown up big time in markets. It's not my strength. I do property. I've been doing this for a long time with my family around the world. It's what I'm good at. And from that perspective, I can actually quickly identify most people that are basically in the wrong perspective to be able to invest in property. It's a patient asset. You can basically walk into your property, wipe out your property manager, paint the thing pink, do whatever you like. You invest in BHP, let's see you do that. Let's see you wander in there and paint everything pink and obviously fly the seat. You can't do that. You're susceptible to whatever the board decides you can do. With these investments, you change your mind. That's 10 push-ups. I'm making push-up theory today. This is awesome. But yeah, it's unfortunate, but some people just can't. This is where we're traveling to. There's only one person here that unfortunately just didn't read my emails, I think, but I'm working on him. I'll fix it. I'll fix it. Everyone's got all their internal flights booked. Everyone's got all their accommodation booked. Outstanding. Okay, fantastic. There is a reason. I'm pretty sure we clarified this with most of you, but there is a reason we didn't actually book this for you. Some of you fly business first, economy. Some of you stay at backpackers, friends, family, Hilton. You know, it's just easier we let you do it on yourself. By the way, it's all tax deductible if you have investment properties here. That's why you fly business and go for the Sheraton. You know, but whatever. Either or any. One of our other members actually does have an intention to vacate a property, just so they can obviously get in a position where they can go back and travel there. Some others have actual family and friends they want to come back and stay with. There are implications if you do that for your tax bracket. So once again, on your individual circumstances, just make sure you chat to us so we're pointing you in the right direction of who to speak with and obviously the resolutions you get there. I think my favourite here, apart from Kansas City, this is obviously where Big Ben is. And if I can get Big Ben in the room when you're ready, that'd be awesome. No breaks. We've got a lot of stuff to do. They've flown 14,000 kilometres. By the way, I'm paid by the hour, so that's why I'm just going to keep going. Thank you, my friend. I thought he took off down to the table, so that's good he's actually still here. Okay, so we're also going to be obviously hitting Indianapolis and Dallas, 3 completely different markets, 3 completely different reasons we're there. We're getting into Dallas for capital growth. That's probably the most exciting thing you're going to be able to see. We bought in Phoenix, as Lou mentioned earlier, we bought in Phoenix for 60, 70, 80,000. I think there was a gentleman in here from the Phoenix trips, the previous department of the company. I don't see many now. We had one of those properties recently sell for 120. They bought it at 85. That was in 12-month cycle. Like, they're growing quickly now. They are moving very quickly. Other properties, because of where they bought, not as high. Okay? But what we're also looking at, Kansas City is a net return. If we get capital growth there, it's a bonus for us. We don't actually factor for it. We've already started seeing it, but we don't factor for it. Atlanta, Georgia, we've just closed out of. There's a $500 million hedge fund rolling through right behind us that's pushing those prices up, and we believe hyperinflating that market. It's volatile to us and our investors, so we're just out of there. We still hold stock there, but I don't see a benefit in being able to charge you $20,000 more for it when I could have given it to you for $20,000 less, which is why we rushed to get Dallas basically in a position where you can buy it. Some of the properties aren't ready yet. Just not ready. We're still going to get them refurbed. We're still going to vet the tenants that are in place or get new ones in place if we didn't like the look of their hair or whatever it might be. But at the same time, obviously, it's a good reason to go to Dallas. Anyone else see the TV show Dallas? Anyone? It's nothing like that. Okay, that was Hollywood. I think we're going to bring, this is basically just the previous tour that we'd gone on as well. A lot of these people I still speak to. This gentleman right here is probably one of my arch nemesis right now because he's actually finished his A20 skydiving license and I just don't have time for that anymore. He was meant to be here. Unfortunately, he wasn't able to make it because he died in a plane accident, but that's okay. That's fine. I'm kidding. I've got a bad sense of humor. I haven't slept. So this is obviously during the tour. This is pretty much what you'll expect. We're going to be pretty easy going. I mean, it's not like Vegas. You can't walk around with booze in your hand much. But it's just going to be really light and easy, okay? We're not going to be rushing from place to place. That's why we've allowed you a full day of travel between hand, so you can get around the city, see and experience things for yourself. You know, take me out for a drink, whatever you want to do. You know, so it's really up to you. But it's important you get as much out of this as possible. I lived here for years. We've got 2 reasonably attractive Americans up the bank that'd love to be able to answer as many questions for you as possible. It's what we're here for, okay? Because we're your employees, remember? So just basically use and abuse us. We'll make sure that we get around to a good variance of stock. We'll make sure that we get around to obviously a lot of different areas. We'll be seeing good, the bad, the ugly, and Ben's place. So it's obviously going to be a pretty good exposure for you to get a greater understanding of where you're going to be and therefore why, and what you can therefore expect over the next, let's say, 5 years, 10 years, 15, 20. Okay. Beautiful tour. Question and answers. Anyone's got any questions or answers yet? No answers? No? Not even you? You're just fighting a hangover today, aren't you? That's fantastic. Like I said, just come up and ask us. Maybe too embarrassed to ask things in public, so we're going to probably play a little bit of game later to make sure people are out of their comfort zone. Del, what will basically happen In this scenario, okay, so let's say we've got a good one. Let's say for whatever reason, he's a doctor, for example, okay, and for whatever reason, his work, it just ceases and can't make the repayments. The first communication is going to be to the property manager, I can't make my payments. They'll know this, however, when the payments don't come in. That's when the alarm bell gets raised. That's when on your portal, which is your access point for all of your property managers, you don't have to sit up at 3 o'clock in the morning, it just comes to you via email. There's an issue. Shower head's leaking. Neighbour broke the window. Rent's not coming in. You know straight away. They'll also confirm with an email, usually in about 40 to 72 hours, that via email, this is their action, this is what they're needing to do. They might even say to you at that point, we need to evict. Okay, worst case scenario. I'm not always a happy, nice little guy, I'm a pessimistic optimist. Okay, so worst case scenario, they have to evict. That's going to take a certain amount of time. This isn't your problem. However, in the net returns that I calculate and that most of you are already seeing on the properties, we've already factored for a vacancy rate. Okay, there's a percentage removed from that figure, so that's already factored in. Okay, what you're seeing is worst case scenario. But at the same time, it's not your problem. That's why you're paying the property manager 8%. Historically, in the US, you'll be paying 10, but because you're 21st century members, you get it for 8. Okay? Now, if for whatever reason, let's say they don't do their job, it's their cousin. Okay, I'm going to give worst case scenario, because that's obviously the skepticism you have. It's their cousin, and they just say, no, it's going to be fine, it'll pay next month. Worst case scenario. We don't get these property managers, but we'll make it to this example. You're in a position whereby you've got myself and a very, very big, ugly American right there that'll fix it, okay? Because it's not your problem. There's a reason, obviously, you've got a membership that doesn't just, there's your property, off you go. It's there's your property, what's next? What do you need? Tax time? Not a problem. Property manager? Not a problem. Whatever it might be. That's why, in that sort of an environment, it still isn't your problem. If they're not doing their job, I've got 10 others that'll replace it in a drop of the hat, okay? And we fix it, because we're not going anywhere. So what Dell's basically saying here to people is, let's say you buy a property at 50,000, it goes to 100 grand in value. Until you sell that property, you haven't realised the capital gain. In the US, there is no CGT, there is no gains tax you'll pay there. The government, the Australian government, which is your principal place of residence for taxation purposes, which the ever boring and impressionable Warren Black will be talking about a little bit later today, okay? Don't get him started talking about the Collingwood Football Club, because he does bill by the hours and that's his favourite team. He's a lovely guy, I'm kidding, I give him a hard time. The problem here basically being, and I have to be very clear about this, I'm not licensed to give financial advice, okay? Whatever I say is basically based on scenarios that either I have done, my family's done, or I know of others have done. What you can do, and the same point being, it is immoral for you to skip on taxes. There's ways to minimise tax, but it's obviously immoral. Aside from illegal, which is obvious, find a way to give back. But the point you're trying to make is the fact, how do you make sure you're not just handing back all of your profits to the Australian government? You take that 50 grand additional, let's say you sell that property, you make the additional 50 grand, you've now got 100 grand to spend, you buy another 2 properties. They can't take, if you're investing back in the same vehicle that produced that actual revenue, they can't touch it, because then it's not a realised gain. Because of the structure you've got it in, being the limited liability company, and obviously the way that you're actually going to go back and grow your portfolio, bear in mind you're making a net return off this. You're making an income as an employee of your LLC. Okay, in theory, this all depends on your own scenarios. You'll all have different scenarios that you'll actually go with. But in this model, one of my companies pays me $13 a day. $13 a day. I get billed a lot more for that company, but that's how much they pay me a day. It's nowhere near Australia. It's quite far outside Australia, yet I still declare it in Australia as a tax credit. I make a lot more money in that account, but I don't necessarily realise it for my own personal benefit as much as obviously stimulating my company. Okay? That and the fact that you will find, and this is where I have to be very delicate, I'm not going to actually answer this in a broad spectrum, but when we're connecting you through to, let's say, a US accountant or even Warren Black or any of the other specialists that I can connect you through to, they'll start to explore not what you're doing today and how you actually get the money today, what you plan to do in 3, 5, 10, 15, 20 years' time. Most of you want to retire. My goal, my deadline rather, is 7.5 years. That's when I have to stop working. Some people obviously want to hit it, 55, 60, whatever it might be. You've got to plan for that period. Because that's when all of a sudden you hit a certain age group or a certain point of retirement, no tax. That's an exciting point to be at. But at the same time, then you find ways to obviously give back. You get some sponsor kids, don't deduct them. It's a human life, whatever it is. But yeah, it's a case-by-case scenario, Dell. But that's the easiest way to get around it. Good question, though. Anyone else? Any questions? Yes, Maylene.
So when you buy a property in US or any property, you're obviously wanting it to be in a long haul, say 10 years, 15 years.
Theoretically, yeah.
Right? So how long does 21st Century intend to then help its members through this whole process?
You're here for at least 3 years, at least. By the time I'm finished with you in 3 years, you won't need us anymore. The only reason you'll come back and work with us is because right now, apart from the lovely people that are here in the room, your fellow members, okay, and there's a reason we like to bring you together as much as possible, there's about $250 million worth of buying power. 236 million average is what you represent. That's what, when our suppliers go off into the market, hey bank, I got about $250 million sitting over here, did you want to play with them? What sort of rates will you give me? All of a sudden, you as an individual investor, let's say you got $1 million, not bad, but you won't get as good a rate as when you're buying $250 million worth of stock. So when you're actually coming back through, let's say in 2.5 years, and all of a sudden, you know what, I'm over US, I want to go and invest in Belize, Spain, buy Greece, whatever you want to do, you liquidate your assets, you move over, we'll help you with it. Your property manager will sell the properties for you. The inspectors are already in place to vet the properties, obviously, for anyone coming in. You've got insurance brokers that will obviously cover you through that transaction period as well. You've got lawyers and solicitors and all sorts of other lovely technical people that'll do all the contract and vetting. But moreover, you'll know your options of taxation exit strategy. You'll know your options of obviously being able to protect the amount of capital growth you may have obviously attained as well as the net return. Moreover, you'll know obviously the weaknesses if you were to exit early. You just won't need me. It's hard to say, but it's true. Okay, I train to replace. Some of you have been lucky enough to speak to Sonny. Yeah, anybody not spoken to Sonny yet? Everyone spoken to Sonny? I actually got him a bed at the office. He's got a lovely wife and a young child, beautiful pearl, but I work him very, very hard. But I train him so that if I get hit by a bus, you guys aren't going to be left standing in the cold with basically someone who doesn't know what they're doing. Okay. Similarly, I've got another guy I've just put on who's going to do this exact same thing. I've got another one I'm bringing on. I want a girl this time because I like to mix it up a bit, but it's important that you're always going to have someone to basically assist you and walk you down the aisle. Let's say 3 years plus, for example, you've already got all the contacts in place, yet for whatever reason, they're not responding to your calls or they've gone out of business or whatever. Worst case scenario, we have a member support team in the Melbourne office. They're more than happy to help you out. They've got all the skills that we need as well. Okay, so there's a backup for the backup for the backup. There's always a redundancy. There's always a backup plan. There's always an exit strategy. It's property. You've got to have it.